Hello everyone, thank you so much for joining my channel. Christina Waller here, coming with the video. And in today's video, I wanted to talk about some of the common Forex terms. I have a part one here listed because I didn't want the video to go too long. So I'm gonna do a part two and possibly a part three, but I'm definitely gonna do a part two. So we can go ahead and get started. So these are just normal, regular terms that you will hear with Forex. If you are someone that is researching Forex or thinking about trading Forex, these are some of the terms that you will see and hear. So we can go ahead and get started. Okay, so currency pairs. So currency pairs are two currencies that are traded against one another. The first currency is the base. The second currency is the quote or counter. For example, you have the USD, JPY, which is the US dollar against the Japanese yen. So USD is the base and JPY is the quote or the counter. If you buy USD against JPY, you believe that the USD, the United States dollar, is going to perform more strongly than the Japanese yen. Okay, and here goes some major pairs here. So major pairs contain USD as a base or a quote. The major currency pairs are, and these are the short terms, and this is something that you can research a little more. I didn't want to get too much into explaining too much, but just just some basic information concerning currency pairs. You can go back and research um, the different currency pairs and what the abbreviations mean here. But I just wanted to kind of go over these. You have the Euro USD, USD JPY, GBP, which is the Great Britain pound against USD, the AUD, USD, USD Swiss, New Zealand dollar, USD, USD CAD. Okay, these are considered major pairs. You have cross pairs that are pairs that do not contain USD, such as GBP, JPY, and Euro CAD. And you will also, with that, just remember with the major pairs, USD will be in the base or the quote, okay? And quote also could be, you may see counter as well. There are some exotics as well with pairs, currency pairs. I didn't mention that. The main things to know about would be the major pairs. Definitely will be the ones you want to familiarize yourself with, and also with the cross pairs as well. But definitely the major pairs first and foremost. Okay, so we can continue. So the next term is leverage. Leverage is money that is borrowed from your trading account with your broker. So that's a broker is just where you will be, someone, a company that actually allows you to place your money into an account and you're actually able to trade and that will be your broker. You are able to open a position with a high contract size and less expenditure. So, example, for the pound, the Great Britain pound, USD, you have a contract size of $100,000 per lot. Without leverage, you would need almost $130,000. Using a leverage of 1 to 500, then you're taking the 130,000 divided by the 500, and you can open a position for just a small amount of $260. Okay. Long, short. So with long, just remember with long, buy, short, sell. Okay. If a trader goes long on a currency pair, remember, for example, a currency pair will be two, which would be, for example, USD, JPY, which will be the United States dollar, against the Japanese yen. Okay, the base is bought and the quote is sold. If the trader goes long, she or he is expecting the price to rise. If the trader goes short, she or he is expecting the price to decrease or fall. So for example, here you have Euro, USD. If you're going long, you're buying, and you're buying Euro against USD, and the trader is expecting Euro to rise. If you're going short, you're selling, and Euro against USD, the trader is expecting Euro to decrease or fall. Okay. And our last slide here, PIP. You'll hear about pips. When you see pips on your screen, you'll learn more about MT4, and that probably be one of the terms that I have listed in another video. With pips, if your pips are in the positive, that means that you're making money. You're making money, but if it's in the negative, that means you're losing money. So the acronym for PIP it stands for percentage in point. It is the smallest movement reflected in an exchange rate on a currency pair. The PIP is the fourth decimal on a price quote for a currency pair. It is used to measure volume. For example, you have the Aussie in Aussie with USD. The price quote is 0.6876. The PIP would be 6. It's the fourth decimal on the price quote here, okay? And then for JPY pairs, it is the third decimal on a price quote. So with this one, the price quote would be 0.687, and the PIP would be 7, okay? So again, with pips, just always remember pips, if you are what we would say the blue and blue, which with the MT4, which you'll learn about, they have the color where it's blue. If it's blue, that means that those pips are in the positive. That means you're making money. But if it's red, then that means that you're losing money. So I just wanted to go over a few of the Forex terms that you'll read more about, if you're researching, you'll hear more about as well. And you want to familiarize yourself with those. The couple of resources that I did utilize with the slides will be Baby Pips. In a previous video, I mentioned about Baby Pips is a great resource. Definitely something that you want to look into, a website you want to look into, for research purposes. And then finance magnets as well, as I utilize that as well. You can learn more about Forex trading if that's something you're interested in. With the platform that I'm currently a part of, I'm learning so much about trading. Great opportunity to learn about trading and Forex trading if that's something that you're interested in. I am going to leave more information concerning that below in the description. You can reach out to me if you have any questions as well. I'm going to leave contact information if you have any questions. Definitely reach out to me with those. But I thank you so much for joining my channel and watching my video. Have a great one.